Hello everyone. So it is currently 3:24 a.m. I've really messed up my sleep schedule, so I realized I might as well just make a quick theory video on week 5. So this will kind of be like a study with me, but I'm just going to take you through my notes, and then I'll just chat about the concepts. The idea of this is just so that you can watch it, have the notes with you, and then revise, because there isn't much time left. So those are the learning outcomes. Introduction. What is the value of an asset? The value of any asset, investment opportunity, or project is really the present value of its future economic benefits. And that's important for this module because we're working a lot with net present value. So maybe that'll be asked in a definition question. So this is the valuation process. I don't think that you will get a question on the specific steps. I think this is just to help you when you do the questions. The four main components of a company's value would be the company's operations, non-core assets, debt, and equity. And I think you understand what all of those are, but things that are in a company's operations are things like working capital, machinery, and the income and expenses involved directly in the running of the core business. Non-core assets not critical to the operation of the business. Debt is all long-term debt and non-equity claims of a long-term nature. And equity is the residual value of the company. So that's the value of the operations plus the value of non-core assets minus the value of debt. So the value of the operations, the value of non-core assets, value of debt. So how do we produce value? Through revenue producing cash flows. Cash flows leveraged by a cost of debt that is less than a cost of equity, and through the value of our non-core assets. So a few valuation techniques. So firstly, the free cash flow method, that's the primary one. So you're going to use that when you're valuing a firm in general or just ordinary shares. When do you use this? So if there's no dividend history, if it is an operating unit or a division of a large public company, if it's an unlisted company, or you're figuring out the minority or majority shareholding value. And so what is the value of an ordinary share? The present value of all future cash flows received in perpetuity. So that is those cash flows received in perpetuity discounted to the present value. So free cash flow valuation is the idea that you essentially discount the future cash flows into infinity or for the specific period by the given discount rate. Where you see something like formula check notes, these are the notes I made for myself. So the formula for example, the free cash flow valuation, I put in my notes. I'm just trying to get through the theory in this video. So enterprise value, so that is the value of a business before you allocate any value to ordinary shareholders, preference shareholders, debenture holders, and financiers. And the equity value, very important, is the ordinary shareholders' share of the entity's enterprise value. So that's equity. And that's why you'll often see when you calculate enterprise value, you're going to have to subtract things like borrowings to get to equity value, because equity value is just ordinary shareholders' share of the entity's enterprise value. So the enterprise value is the entire value of the business, and equity value is the value of the business attributable to the shareholders. And then, sorry, with continuing value, your future cash flow valuations, you're going to forecast cash flows for a period of time, and then you're going to assume constant growth thereafter. And the period thereafter is usually your continuing value or your terminal value. And so where constant growth is expected in future cash flows, we can use the Gordon growth model to determine the continuing value at a point in time. So take note of that and make sure you know the formula for it. What is the growth rate? So it's just a forecast for either a particular period of time or into infinity. And so the initial growth rate is a forecast for a certain period of time. If the capital structure has no debt, the free cash flows are simply discounted at the entity's cost of equity. So we don't have to worry about the cost of debt when we discount. Especially think about in the previous videos, week 7, working a weighted average cost of capital. When we discount it, we use the weighted average cost of capital. But obviously, if there's no debt, we can just use equity. In this case, so that's what I just said. If debt is included, then the determination of the discount rate becomes more complete, sure, because you have more information. So earnings-based valuations. So this is just about the different ones. So you get price earnings, So that'll be things like the PE. This isn't super important for the test. So the problem with the price earnings is it doesn't really take into account the entity's capital structure. With adjusted earning multiples, when you value a private company, use earning multiples of similar listed companies and or sectors of the JSE to establish an appropriate range of these multiples for the company. Not super important. Sustainable earnings. Yeah, I'm not even really going to fully go through this because this is not important. So why are earnings-based valuations cool? Because they're easy to understand. Maybe something like this could be asked in a question. Why are they bad? There's quite a lot of bad. So they're difficult to adjust for specific risks. They're based on accounting earnings that can be manipulated, unlike cash. Cash is king. It's difficult to recognize the positive and negative effect of working capital management. We're focused on historic profits because it's difficult to incorporate long-term profit forecasts in our valuations. It's not sensitive to risk, and it's not suitable for valuing early stage or high growth businesses, as the profits in that period are not sustainable. There we go. I had something here on EBIT, but I forgot to add it in, so whatever. The net asset value method, estimating the fair value of the assets and liabilities of the business so as to derive the fair value of the equity. So we often use that when we value businesses that are about to be discontinued through liquidation. It's most useful for valuing a business when the fair value is largely made up of the fair value of its underlying assets, so not really applicable to most of the questions that we would get. And so that would probably be if you had a huge company, a manufacturing company that wasn't producing anymore. The main asset or the main thing you care about that it has this value is just the work, or the capital, the factory, the whatever. Okay, dividend-based valuations. I didn't put any notes there. Market multiples. I'll be honest with you, I have not seen any questions on this. So you can go through the notes on that if you want. I'm not going to. In general, free cash flow is recognized as arguably the most technically correct method, and that's why most of the questions we get will be on the free cash flow, if not all of them. Ignore this. Oh, I locked it. Wait, never mind. Unlock for me. Okay. I will also link this in the description if you want these notes. You can just pay me R0. The discount rate. So usually for the discount rate, when we're doing the free cash flow, we use the cost of equity. So we can use the capital asset pricing model. We can also use, as you've seen in week 7, sometimes we'll use the Gordon growth model. But also in these questions, especially when you're doing the free cash flow, you can use the weighted average cost of capital. And so, again, this is a bit tautological. A lot of it has already been done in the previous videos, but just so you know, weighted average cost of capital is the discount rate that I've mentioned before, and you should know that from the notes. When you value an ordinary share, a few steps. So you want to calculate the future sustainable earnings per share. Then you want to choose a comparable listed company and adjust the price equity ratio for different risk and growth factors, or use an adjusted sector average price equity ratio. I think that's what PE stands for. Finally, you want to calculate the value per ordinary share. And so that is comparable price equity ratio times sustainable future earnings per share. So we want to adjust for exceptional or non-reoccurring items, profit or loss on discontinued operations because that cash flow won't continue into the future, adjustment of expenses to realistic levels, and adjustment of non-operating income or expenses. So equity value, we take the latest closing share price and we times it by the total diluted shares outstanding. The enterprise value, this is a formula you will use, is the equity value plus the net debt plus preferred stock plus minority interest. And so net debt is just your total debt minus cash and cash equivalents. And so advantages and disadvantages of a PE ratio is that it's quick and easy to use. The info is readily available, and it's useful in the valuation of majority interest. But oftentimes its adjustment is subjective. Earnings are affected by accounting policies which vary across firms. It ignores the time value of money and doesn't rely on cash flows, which is very important for us finance people. I'm not a finance person necessarily, but in general. May not take the future into account, especially if it's based on historical earnings, and these points here as well. So some other comparable market valuation methods. These are not super important, and I haven't seen these being asked in questions. So we'll close that. If you're interested in it, you can look at the notes in the description. So the enterprise value and the EBITDA is the earnings before interest, taxes, and amortization, and depreciation, I believe. Sorry, I think I might have missed adding that. We use it because the PE ratio is sensitive to different capital structures or leverage. And so many analysts use the enterprise value or the earnings before interest, taxes, and amortization ratio of a comparable listed company to estimate the total value. And so the formula here, the EV of a comparable listed company is the value of the firm, which is the value of its debt plus the value of its equity. And when we say V, we mean the market value, not the book value. And so the total value is just going to be this, EV over EBITDA times the EBITDA of the firm being valued. So this is EV over EBITDA of a comparable firm times the EBITDA of the firm being valued. So why are free cash flow valuations good? Because we focus on cash flow generation. They have a long-term view of the generation. And we are able to identify the key value drivers in the business. And we can really perform very extensive sensitivity analysis. The problem is it assumes companies continue operating on the same business model forever, and also stock markets may not be efficient at all times. And so data such as market risk premiums and company betas can be flawed, contrary to the efficient market hypothesis. So problems with valuing private companies. There are no beta coefficients, so we don't always know how risky it is that a specific company is compared to the rest of the market or the performance of a market. The shares are not freely tradable. It sometimes may be hard to know how much the shares are, how much they cost, what they're being traded for. So reported results, like the accounting, you might have abnormal expense item because of the ownership structure. They could be subject to specific risks that larger public companies aren't, like the over-reliance on key personnel, because they're usually smaller companies. And so because they're smaller, their profits can also be quite volatile. And just to note that some of these factors affect the value of private companies, and therefore private companies are usually valued at a discount to listed companies, which is the private company discount. Probably not going to be asked in a question, but probably good to know. Might be 1 or 2 marks. Minority discounts. And so when you have a minority shareholder who can't change the management team or sell control of the company or list the company or amend the MOI or set dividend policy, so they can't do any of that without the support of the controlling shareholders because they only own maybe 10% of the shares. And so because they don't have material influence over the company's affairs, acquirers usually pay less for a minority stake than they would for a controlling interest, which makes sense, right? If you buy 49% of a company compared to 51, if you have 51, you basically own it. If you have 49%, you might as well have 10%. Not necessarily, but you don't have majority. It's like if you win elections, who wants 49% of the vote might as well get 20, right? Especially if it's a win or lose situation. So 51% matters more than 49%. Control premiums. So arguments in favor of paying that include the fact that most buying and selling of shares on a stock exchange happens in small quantities, and therefore the share prices do not reflect the prices of buying control. I don't really know what that means. I'm not gonna lie. I'm sorry. So comparable PE ratios, so levels of the shareholding and implications. So 0.01 to 24.9, you have minority shareholding with no control. 25.01 to 50%, no control, but you can stop a special resolution. From 50 to 70.401, you control investment and you can pass an ordinary resolution. And from 75 to 100, you can pass a special resolution. So that would be something like issuing new shares or voluntary liquidation. For those of you who have done company law, you should know these things. When it comes to valuing debt instruments, the market value of a debt instrument is the present value of all its associated future cash flows discounted at the market-related cost of debt, such as bonds. So we'll know that whenever we do like a bond in perpetuity, we always discount it to a present value. And so some concluding remarks on the theory is that valuations are inherently futuristic. The free cash flow is the most technically sound, so it's really nice. Earnings-based valuations are not that great, and they oftentimes rely on data that is provided by stock markets, and so they represent the market's valuation of the company. And so we oftentimes can't predict the future fully. So the objective in valuing a business is just to minimize the margin of error. And so we've discussed three valuation approaches: the asset approach, the income approach, and the market approach. Sorry if this was a bit quick, if I was rambling at times. I did not prepare this video. I just thought for those of you who are doing some very quick revision and maybe are a bit lazy to read, you can just watch this video. Maybe it'll just remind you of some stuff that you already know, or you can look at the notes as you do some calculations. And yeah, I hope it helped. Good luck for the test, guys.